Okay, so in this video, we'll be discussing about monetary policy. Okay, so by definition, monetary policy is the demand side of economic policy. It refers to the actions undertaken by a nation's central bank to control money supply and achieve macroeconomic goals that promote sustainable economic growth. Okay, so essentially, ang ating authority for the monetary policy is the central bank. Dito sa Pilipinas, we have the Bangko Sentral ng Pilipinas, and we have the Monetary Board. They are the ones implementing the monetary policy. The monetary policy, essentially, the central bank has this, they do have goals with regards to economic growth, let's say GDP, and then we have also, they try to control the inflation rate, and sometimes they could affect those factors by controlling the monetary supply or the amount of currency that's in circulation in the market. Okay, and aside from that, of course, they'd also like to achieve macroeconomic goals. Okay, those would include the GDP, the inflation rate, things like that. Okay. Key takeaways: monetary policy refers to the actions undertaken by a nation's central bank to control money supply and achieve sustainable economic growth. Okay. Monetary policy can be broadly classified as either expansionary or contractionary. Later, we will be discussing those. Tools include open market operations, direct lending to banks, bank reserve requirements, unconventional emergency lending programs, and managing market expectations subject to the central bank's credibility. Okay, so essentially, the monetary policy also includes the regulation of financial institutions, because the financial institutions are directly involved with the saving and issuance of the country's currency, right? So the general public would put their money into the bank as savings or as investments, and then the banks or other financial institutions would release them to the public through loans to individuals, to entrepreneurs, or to businesses, okay, who would then use the money to operate their businesses, which would contribute to the economic growth, increase in GDP, and of course contributory to economic growth in terms of employment, allowing people to have money to spend on. Okay. Understanding monetary policy. So monetary policy is the process of drafting, announcing, and implementing the plan of actions taken by the central bank, currency board, or other competent monetary authority of a country that controls the quantity of money in an economy and the channels by which new money is supplied. Okay, so here in the Philippines, we have the Monetary Board, which is part of the central bank, Bangko Sentral ng Pilipinas, and the only institution allowed to print new money, to supply new money into the market, is the central bank as well. Okay, so they do have the power to print new money and to supply new money when needed as part of their monetary policy. Policy, essentially, it's actions to be taken by central bank in order to stimulate activity in the market or in the economy. Okay, it would depend on the situation whether they need to infuse money into the market or whether they need to contract, take back money supply from the market. Okay. Monetary policy consists of the management of money supply and interest rates. So Bangko Sentral also regulates the implementation of interest rates aimed at meeting macroeconomic objectives such as controlling inflation. So interest rates in a way related to controlling inflation, consumption, growth, and liquidity. This is achieved by actions such as modifying the interest rate or selling government bonds, regulating foreign exchange, forex rates, and changing the amount of money banks are required to maintain as reserves. So all these are being regulated by, again, the central bank through the Monetary Board. Economists, analysts, investors, and financial experts across the globe eagerly await monetary policy reports and the outcome of meetings involving monetary policy decision makers. Such developments have a long-lasting impact on the overall economy as well as on specific industry sectors or markets. Okay. The BSP, they do provide annual reports, and if I'm not mistaken, they also provide quarterly reports, which can be found on their website. And then with regards to, targeted inflation rate, targeted GDP for a particular year, they also make reports on that. And I think they also release quarterly reports. Let's say as of March 2021, the GDP is down from, the target GDP for the year. And then with regards to inflation, let's say as of March 2021, we're already hitting the targeted inflation rate. So, the monetary policy would need to control that to ensure that by the end of the year, the highest inflation rate would be the targeted inflation rate, right? And so economists, analysts, investors, financial experts, they do await, the monetary policies and the reports that they provide so that they could make informed decisions. And, if there are changes that they need to make with regards to their investments or with their reports as well, or with normally they are part of financial institutions too. And so they would need to have those information to properly, implement certain projects, certain programs to ensure that they get the most benefit out of a certain situation. Okay. And then monetary policy is formulated based on inputs gathered from a variety of sources. For instance, the monetary authority may look at macroeconomic numbers such as the gross domestic product. This is the measure of economic growth. And then we have inflation, industry sector specific growth rates, and associated figures. Normally, certain industries are being monitored, but I'm not sure if it's division or if they do have a certain organization. And then those organizations would provide the numbers, right? As well as geopolitical developments in international markets, including oil embargoes or trade tariffs. So these are for companies that are doing export or import. And then, they would be affected by international laws and regulations, as well as, different political situations in different countries, right? If they are transacting with those countries. These entities may also ponder concerns raised by groups representing industries and businesses, survey results from organizations of repute, and inputs from the government and other credible sources. Okay. Monetary policy requirements. So monetary authorities are typically given policy mandates to achieve a stable rise in GDP, keep unemployment low, and maintain foreign exchange and inflation rates in a predictable range. Okay, so we've been mentioning GDP and inflation earlier. So apparently these are also included. Keep unemployment low. By stimulating economic activity, what they're hoping to achieve is that more people would be employed, and employment would translate to people having the money to spend on goods and services, and spending or availing goods and services would then translate to contribution to GDP. Okay, so it's essentially a cycle, right? Businesses would pay their workers, and then the workers would represent the household, and then the household would spend the money, and that money would redound back to the businesses, because the household or the employees would buy the goods and services from other businesses as well. So it's just a cycle, right? And normally what do you call that? There's the so-called multiplier, right? That how many times in a year the money circulates in the economy, then that would also contribute to the GDP, right? Important. Monetary policy can be used in combination with or as an alternative to fiscal policy. Normally, monetary policy is the first one being implemented, and only if the monetary policy cannot control cannot help in contributing to or impacting the GDP, unemployment, inflation, forex rate, interest rates, then it should be complemented with fiscal policy. And then in fiscal policy, it uses taxes, essentially introduction of new tax rules or tax laws, government borrowing and spending to manage the economy. Okay, but of course the government would have their own transactions, so essentially that would also be part of the fiscal policy because our government does borrow money continuously and of course paying those back. And then spending to manage the economy, there are a lot of government projects, and government projects would mean that money is going into the economy, right? When they create those projects, then they would need to buy the materials, they would need to hire contractors, they would need to employ workers to do the job. So by releasing the money into the market, into the economy, so that's also infusion of money or currency in the market. The Federal Reserve Bank is in charge of monetary policy in the United States, BSP in the Philippines, commonly referred to as a dual mandate to achieve maximum employment while keeping inflation in check. Essentially, it's the same for the Philippines. I think it's the same as well in other countries. Simply put, it is the Fed's responsibility to balance economic growth and inflation. Yes. In addition, it aims to keep long-term interest rates relatively low. Its core role is to be the lender of last resort. We've studied this in banking and financial institutions. Essentially, what it means is that if a financial institution, especially banks, are struggling financially, then the central bank would have to lend them money so that they could continue their operations and, of course, assist them as well by providing consultancy, advisorship, to ensure that they would be able to survive so that, it would not affect a lot of people. Essentially, it would affect, the workers of that financial institution, the depositors, those people who put their money into that particular financial institution, and then, of course, transactions with other financial institutions and other people who have borrowed money from the bank. Okay, essentially, when a financial institution is in trouble, it might mean impacting a lot of people, so they don't want that to happen, so they have to be the lender of last resort, providing banks with liquidity and regulatory scrutiny in order to prevent them from failing and panic spreading in the financial services sector. Actually, the BSP, the central bank, does monitor banks and other financial institutions, but most especially banks. And then whenever there is a particular bank that's having trouble, they would release reports, but they would never name the particular institution, because naming the particular financial institution, in a way, it's understandable because that might create more trouble for them. The depositors would probably, just withdraw their money, in which case it would be detrimental for that particular financial institution. But on the part of the depositors, if that particular bank fails, then it would be in trouble for them, right? But still, they're looking at, the bigger picture. So they're trying to protect the financial institution as a whole and not the individual interest of the depositors or the investors. Okay. What's this? This is in the US. They announced that they will no longer raise interest rates due to unemployment falling below a certain level if inflation remains low. It also changed its inflation target to an average, allowing prices to rise somewhat above its 2% target to make up for periods when it was below 2%. Types of monetary policy. So we have two, expansionary and contractionary. So expansionary, if a country is facing high unemployment rate during a slowdown or a recession, the monetary authority can opt for an expansionary policy aimed at increasing economic growth and expanding economic activity. That's why it's called expansionary. As a part of expansionary monetary policy, the monetary authority often lowers interest rates through various measures. Why do you have to lower the interest rates? When the interest rate is low, then people are, encouraged to borrow from financial institutions because the interest rates that you have to pay is low, right? When you're a borrower, what you want is for the interest rate to be lower. So what they do is they lower the interest rates. That would encourage people to, individuals, groups, and businesses to borrow money from the bank. And so they would have the fund to operate to the business and essentially to stimulate further economic activity, right? Serving to promote spending and make money saving relatively unfavorable. Okay, make money saving relatively unfavorable in such that on the part of the depositor, low interest rate. So when you put your money into the bank, you're going to earn lower interest rate because the monetary policy lowered the interest rate. So instead of putting your money into the bank, you'd rather, spend it rather than saving your money. So in that case, it's also encouraging spending, okay, instead of saving. Increased money supply in the market aims to boost investment and consumer spending. Lower interest rates mean that businesses and individuals can secure loans on convenient terms to expand productive activities and spend more on big-ticket consumer goods. Okay, an example of this expansionary approach is the low to zero interest rates maintained by many lending economies across the globe since the 2008 financial crisis. Okay, contractionary, essentially this is the opposite. Increased money supply can lead to higher inflation, raising the cost of living and cost of doing business. Okay, inflation, the prices of goods and services go up. Okay, and so cost of living would increase, cost of doing business would also increase. Contractionary monetary policy, increasing interest rates and slowing the growth of the money supply, aims to bring down inflation. Okay, with lower money in the market, then people would have no money to spend on, and essentially slowing down the spending would also mean that the inflation would slow down. Okay, so it would not continue to go up or increase. Okay, so essentially in a contractionary, there's too much money in the market, so what they do is they take the money back into the reserves, right? Okay, this can slow economic growth and increase unemployment, but it's often necessary to cool down the economy and keep it in check. Okay. On the other hand, the opposite of the expansionary, they would increase interest rates. By increasing interest rates, people would be encouraged to save their money, so they're not going to spend it. Okay, and then it would also discourage people from borrowing because you're going to pay high interest rates, so I'd rather not borrow. So without borrowing, there's less people who would spend money. Okay, and with lesser spending, that would curb the growth of inflation. Okay, so it would not continue to go up. Okay, on the one hand, essentially, it's already a bad situation when the interest rates go higher than the target inflation rate. So essentially, when you're trying to control it, there would really be negative effects, like one, slow economic growth, and then secondly, increase unemployment. Okay, because you're trying to lessen the money in the economy or in the market. So businesses would have no source of funds. Let's say they cannot borrow from the banks because the interest rates have gone up. So without additional funds, they cannot hiring more people, or sometimes they would be forced to lay off more people. So things like that. It could increase unemployment. Okay. In the early 1980s, when inflation hit record highs and was hovering in the double-digit range of around 15%, wow, the Fed raised its benchmark interest rate to a record 20%. Though the high interest rates resulted in a recession, it managed to bring back inflation to the desired range of 3% to 4% over the next few years, and that is much more important. Okay. Tools to implement monetary policy. So central banks use a number of tools to shape and implement monetary policy. Some of them are as follows. First is the buying and selling of short-term bonds on the open market using newly created bank reserves. How does this help? When the central bank buys, okay, when they buy, so they give money, right, to the seller. So in that case, they are infusing money to the market. Wait, sorry, buy. Yeah, yes. They're buying, okay? And then when they are selling short-term bonds, they sell, so they get money from the buyer. So that is contractionary in such that the money goes back to their reserves. Okay? Instead of it remaining in the market, it goes from the market to the central bank. Okay, so in that sense, it's a contractionary measure. Okay, that's one way of how they control the amount of currency that's in the market by buying and selling short-term bonds. Okay. This is known as open market operations. Open market operations traditionally target short-term interest rates, such as the federal funds rate. Okay. Normally, if they are the seller of short-term bonds as a government agency, it's normally at a low rate only, right? Because it's a low-risk, low-return investment. The central bank adds money into the banking system by buying assets. Okay, whenever they buy something or whenever they implement a project, okay, they're the ones spending, so the money goes from the central bank to the economy. Okay, or removes it by selling assets. Okay, when they sell, then they get the money from the market or from the economy to the central bank. So contractionary. Or more dearly at higher interest rates until the central bank's interest rate target is met. Open market operations can also target specific increases in the in the money supply to get banks to loan funds more easily by purchasing a specified quantity of assets in a process known as quantitative easing. Okay, so essentially what they're trying to control here is the monetary policy, the monetary supply as well as the interest rates. Okay, second option used by monetary authorities is to change the interest rates and/or the required collateral that the central bank demands for emergency direct loans to banks in its role as lender of last resort. In the US, this rate is known as the discount rate because, as a lender of last resort, you're doing it through a financial institution that's already having financial trouble. So the rate is pretty much lower than the normal. Charging higher rates and requiring more collateral, an example of contractionary monetary policy, will mean that banks have to be more cautious with their own lending or risk failure. Conversely, lending to banks at lower rates and at looser collateral requirements will enable banks to make riskier loans at lower rates and run with lower reserves. So in a way, let's say they issue a guidelines, or normally Bangko Sentral ng Pilipinas, they issue circulars, right? They could change the requirements that banks could could impose in their lending activities or in their financing activities, and making the requirements easier would mean that more and more people could easily borrow from the banks, the financial institutions, or making the requirements stricter, or it would make it much harder for borrowers to get loans from financial institutions. So that's another way that they control the supply of money in the economy. Okay. Thirdly, authorities also use a third option, the reserve requirements, which refer to the funds that banks must retain as a proportion of the deposits made by their customers in order to ensure that they are able to meet their liabilities. Lowering this reserve requirement releases more capital for the banks. Let's say from 20%, they make it 10%. So they have 10% more which they can use to lend to, to borrowers, right? So having that, there would be more money in the market. But if they increase that, let's say from 10%, they increase it to 20%. So that 20%, instead of being able to lend to borrowers, they have to maintain that in their reserves because of as part of the reserve requirements imposed by the central bank. So again, that's another way the central bank is controlling the monetary supply. All right. In addition to the standard expansionary and contractionary monetary policies, unconventional monetary policy has also gained tremendous popularity in recent times during periods of extreme economic turmoil, such as the financial crisis of 2008. The US Fed loaded its balance sheet with trillions of dollars in treasury notes and mortgage-backed securities. Introducing new lending and asset purchase programs that combine aspects of discount lending, open market operations, and QE. Monetary authorities of other lending economies around the globe followed suit, with Bank of England, European Central Bank, and the Bank of Japan pursuing similar policies. We would have to check on this unconventional monetary policies. That would be for later. Lastly, in addition to the direct influence over the money supply and bank lending environment, central banks have a powerful tool in their ability to shape market expectations by their public announcements about the central bank's own future policies. Central bank statements and policy announcements move markets and investors who guess right about what the central banks will do can profit handsomely. Some central bankers choose to be deliberately opaque to market participants in the belief that this will maximize the effectiveness of monetary policy shifts by making them unpredictable and not baked into market prices in advance. Others choose the opposite course of action, being more open and predictable in the hopes that they can shape and stabilize market expectations to curb the volatile market swings sometimes triggered by unexpected policy shifts. So sometimes the central bank does provide quarterly reports, annual reports. Sometimes they releases circulars or updates on the market situation, economic situation. So sometimes they would also hint at creating policies, creating new rules, or releasing new requirements or things like that, which could affect how the economy works or how the economy operates. Okay. And then we have special consideration. So policy announcements are effective only to the extent of the credibility of the authority responsible for drafting, announcing, and implementing the necessary measures. In an ideal world, such monetary authorities should work completely independent of influence from the government. So, no political pressure or any other policy-making authority. So they are the ones responsible and would be held accountable for all their issuances. So in reality, government across the globe might have varying levels of interference with the monetary authorities working. It may vary from government, judiciary, or political parties having a role limited to only appointing the key members of the authority. So here in the Philippines, BSP is technically under the DOF, and then of course DOF is under the president. And I think members of the monetary board, or at least the chairman, is an appointed member by the president. Okay. Alternatively, it could extend to forcing them to announce populist measures, say for example, to influence an approaching election. So thankfully, I don't think that's the case here in the Philippines, right? If a central bank announces a particular policy to put curbs on increasing inflation, the inflation may continue to remain high if the common public has no or little trust in the authority. While making investment decisions based on the announced monetary policy, one should also consider the credibility of the authority. So take, for example, the movie Default, wherein essentially the issuances or the statements made by the Monetary Board or the Ministry of Finance were not in any way reflective of the actual situation, so they are not credible. And so there would be people who did believe them, and yet there are also certain groups, certain individuals who did not, and still made decisions based on what they know, what they have observed, and so some of them are not, duped or deceived by the authority statements. Okay, so the same with this. One reason why we are studying this is so that we can see for ourselves and we can observe for ourselves what are actually happening in the economy, and in a way, based on our own observations, we can predict or we can estimate or judge what the monetary monetary board's actions would be with regards to the monetary policy. And we have that certain expectation that because these are observations, we expect them to do this and that. But if they do the opposite, we would be, questioning them in a way. So it's very important that there would be people who are actually watching the economy. Okay, so that's why we have, analysts, experts, and of course you have the investors. But majority of the investors, they are pretty much silent participants, but still, we all benefit from the monetary policy because the statements or regulations do contribute in the growth of our economy and stimulating economic activities. And also, they control the inflation rate, which is a very good thing. And they're also trying to get a balance for employment and the interest rates and the money supply in the economy. Okay, so those are good things. Okay, so that ends this one. Again, we've discussed the monetary policy, their importance, their role, and of course their objectives on why we have monetary policy. So that's it for this one. Thanks and bye.